As the U.S. markets are closed for the weekend, this being Saturday, November 1st, 2025, we have a clear and final picture of the week for Beyond Meat, ticker BYND. It finished its last trading session on Friday, October 31st, at a devastating $1.66 a share. In after-hours trading, it held steady, also at $1.66. This is a stock that IPO'd at $25, rocketed to an intraday high of over $230 a share, and is now trading for pocket change. The common expectation, the one that built that $230 bubble, was that this was the future of food. This was the Tesla stock of protein. The narrative was that a wave of conscious consumers would abandon traditional animal agriculture for a cleaner, greener, healthier alternative, and Beyond Meat would be the one to supply it. The reality, as evidenced by this $1.66 stock price, is that this company is on the brink of extinction. The market is not pricing this for a rebound. It is pricing this for bankruptcy. The most critical insight you can have right now is that this price reflects a profound and likely irreversible failure of the core business model. This is not a dip. It is a death rattle. The story of Beyond Meat is the ultimate chronicle of expectation versus reality. The expectation was built on a brilliant, world-changing idea. Investors, from large institutions using Fidelity Wealth Management to small retail traders on the Robinhood app, all bought into the same dream. They saw the headlines, the superstar athlete endorsements, and the massive partnerships with McDonald's and Yum brands. They looked at the growth of Nvidia stock or Apple stock and thought they were looking at the same kind of tech-driven, high-margin, world-conquering business. They opened their Fidelity IRAs and individual brokerage accounts and poured capital into the story. The reality, however, is that Beyond Meat was never a tech company. It is a food manufacturer. It is a capital-intensive, low-margin, high-competition business. And the core of this collapse is simple. The company is losing an astonishing amount of capital. Its sales are in free fall, and the consumer has rejected the product. Let's look at the recent stock movement and the financials, because this is where the entire story is told. The 52-week range for this stock is between 50 cents and $7.69. We are just over $1 above its all-time low. The stock has been in a state of perpetual collapse. Just this past October, the company was forced into a desperate move to save itself from a near-term bankruptcy. It had over $1.1 billion in convertible notes due in 2027, an amount it had no possibility of repaying. It was forced to execute a debt-for-equity swap, exchanging that debt for up to 326 million new shares. This single move increased the share count by nearly five-fold. For anyone holding the stock, it was an act of catastrophic dilution. The stock crashed 56% on October 13th, the day this was fully digested. This wasn't a strategic move, it was a desperate triage to stop the bleeding, and it has all but wiped out existing shareholders. This is why you see analyst price targets from firms like Mizuho and TD Cowen at $1.50 or even $1.80. They are telling you there is nothing left. The company just released its preliminary Q3 2025 results, and they are abysmal. Net revenue is expected to be around $70 million, continuing its sharp year-over-year decline. The company is hemorrhaging cash. In Q2 2025, it posted a net loss of $33.2 million. Its cash on hand was just $117.3 million, against over $1.2 billion in total debt before the restructuring. This is the definition of a broken balance sheet. But the most horrifying number, the one that shows the business model is fundamentally flawed, is the gross margin. After years of promising a path to profitability, the company's gross margin has collapsed. In Q2, it was just 11.5%, down from 14.7% the prior year. And that's the positive spin. In Q1 2025, its gross margin was negative 1.5%. It was literally costing them $1.15 to make and sell $1 of product, and that's before paying for marketing, R&D, and corporate salaries. This is not a sustainable enterprise. This is a company that is actively destroying capital with every burger it sells. So what does Beyond Meat do, and what went so terribly wrong? The company, as we know, develops and manufactures plant-based meat substitutes, primarily from pea protein. The idea was to mimic the taste and texture of beef, pork, and chicken. The fatal disconnect was between the idea and the product. First, the partnerships, which were the cornerstone of the bull thesis, have failed. The McDonald's McPlant trial, which was supposed to be the key to the kingdom, was a commercial flop. It was tested and then quietly discontinued in the US. The preferred supplier status meant nothing when the consumer didn't buy the burger. The same story played out with Yum brands, KFC, Pizza Hut, and others. The trials came and went, but none of them turned into the permanent nationwide contracts that investors had priced in. Second, the consumer has not just stalled, they have turned against the category. This is the central failure of expectation. The market was not a small group of vegans, it was supposed to be flexitarians or mainstream meat eaters. But this consumer has two major problems with the product: price and perception. In an inflationary environment, Beyond Meat is a premium, expensive product. Consumers are trading down to cheaper animal proteins, not up to plant-based alternatives. But even more damaging is the health perception. The narrative has shifted. What was once seen as clean and green is now viewed by many as ultra-processed. The long, complex ingredient list has become a liability. Consumers are looking at it and deciding that it's less healthy than the simple single-ingredient animal meat it was trying to replace. U.S. retail sales of refrigerated plant-based meat have been in a nosedive, with refrigerated burgers, Beyond's core product, down 26% year-over-year in the latest data. Retailers are actively reducing the shelf space given to these products. This company's story is one of the most dramatic boom and busts in recent memory. Comment below, do you think Beyond Meat can survive 2026, or is a bankruptcy filing inevitable? This is the only question that matters for anyone looking at this stock on their SoFi trading platform or Fidelity trading platform. This brings us to the future outlook. It's a binary path, but one side is overwhelmingly more likely. The bear case, the reality scenario, is that the company is insolvent. The debt for equity just bought it a few more months, not a new life. The sales will continue to decline, the cash burn will continue, and the company will be forced to file for Chapter 11 bankruptcy. At $1.66, this is what the market is pricing in. The equity will be worthless. This is not a stock for a Schwab Intelligent Portfolios or any serious long-term investment strategy. The bull case, the expectation lottery ticket, is almost pure fantasy at this point. What would it take? It would require a complete top-to-bottom miracle. First, they would need to invent a Beyond Meat 3.0 that is dramatically cheaper to produce, has a simple ingredient list, and tastes identical to animal meat. This product would have to single-handedly reverse the entire negative consumer sentiment and fix their collapsed gross margins. Second, they would have to do this with almost no cash on hand and a balance sheet in ruins. Third, they would have to regain all the lost shelf space and convince fast food giants to give them another chance. This is not a probable scenario. Anyone buying this stock on Interactive Brokers or Fidelity is not investing. They are buying a 1 in a million lottery ticket. In summary, the fall of Beyond Meat from a $230 Titan to a $1.66 stock is a brutal lesson in market dynamics. The expectation was that a great idea and a great story were enough to build a great business. Investors saw a tech company like SoFi or Tesla stock that was disrupting an old industry. The reality is that this was always a food manufacturing company, and it failed at the fundamentals. The product was too expensive, the margins were non-existent, and the consumer ultimately didn't want it. The $1.66 stock price isn't an opportunity, it's a warning. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Be smart with your money.